Hi, and welcome to this week's market presentation. Latest news. In the latest news, we focus on the war in Iran, which has continued over the past week with no clear end in sight. Transit through the Strait of Hormuz remains largely blocked, with flows of crude oil and LNG still not flowing out of the Gulf. Over the past week, there were statements by President Trump that were hinting towards an end to the war within the next few weeks. However, over the weekend, President Trump once again reiterated his ultimatum to the Iranian government that unless they open the Strait of Hormuz to transit by Tuesday, April 7th, the U.S. would launch widespread attacks against Iranian infrastructure, specifically targeting power infrastructure across the country. This then lowered the expectations in markets for an end to the war in what could be a further escalation in this conflict. Iran's ability to continue to retaliate against its Gulf neighbors, particularly against their energy infrastructure, continues to raise concerns that a further escalation in the war will lead to additional long-term damage to the region's oil and gas production and export facilities, leading to longer-term damage to global crude oil and natural gas markets. Overall, financial and energy markets continue to face extreme volatility, with prices reacting to every headline and every statement, particularly from President Trump. Brent crude oil prices surged towards $110 a barrel as the prospect of an end to the war appeared to be diminishing throughout last week. The OECD has additionally warned of the risk of stagflation if the prolonged energy price shock is to have longer-term damage to the world economy. Weather. Beyond the latest news, weather conditions, also another important factor shaping prices in the short term. Temperatures across Europe over the next 7 to 10 days forecasted to remain mostly above seasonal averages, with the exception being the Iberian Peninsula and southwestern Europe over in the 7 to 10 day period. Precipitation is expected to be rather limited across most of Europe over the next 7 to 10 days, while wind speeds are similarly expected to ease as we move through this week, hurting both the hydropower outlook and the wind power outlook. Crude oil and LPG. Moving towards crude oil prices, here we highlight the volatility in crude oil prices as reports of negotiations help bring prices down, while then statements such as President Trump's ultimatum increase concerns and risk in the market. Nonetheless, as you can see in the price evolution, significantly lower prices further along the curve as market participants are still pricing in an end to the war over the coming weeks or months and a resumption of crude oil flows before the end of the year. Nonetheless, prices in the immediate term for the front month for West Texas crude now above $100 a barrel, with Brent sadly above $110 a barrel. Natural gas. Moving towards natural gas prices eased down over the past week through Thursday. The decrease in the price level largely due to statements made by President Trump this past Wednesday that hinted at an end to the war within the coming weeks, with President stating that military operations were, for the most part, completed and that the U.S. would be ready to pull out in due time. Having said that, given the ultimatum sent over the weekend, we are seeing further renewed bullish sentiment in the market at the start of this week. Lastly, when we look at the evolution of the prices along the curve, we also note the backwardation with, again, those expectations that as flows can resume or are expected to resume later this year, we'll see a much lesser impact on pricing further along the curve. Now, that assumption will certainly be tested if we see further escalations of the war in Iran. Lastly, when we look at the price evolution of the quarter in the forward market, we do note the backwardation in the market with Q3 pricing and spot price, with Q3 pricing higher than that of Q4 of 26 and Q1 of 27, which could complicate injections into storage. Looking at total supply and demand of natural gas, we know a relatively steady total supply picture, even if in the face of decreasing LNG imports over the last week and a half. At the same time, favorable weather conditions and the seasonal decrease in natural gas consumption in Europe helping to manage the decrease in total supply. The improved supply and demand balance over the past week has pushed withdrawals from storage to practically zero. Expectations given the warmer weather over the coming 7 to 10 days, potentially leading to the beginning of injections into storage, which will be quite needed as storage levels remain at around 29% full, roughly 6 percentage points lower than last year's levels. Global price competition for LNG remains high at the moment, given the bigger impact that the war in Iran has had to the physical flow of LNG into Asia. We continue to see Asian LNG prices above those of Europe. And as a result, we have noted LNG cargoes out of the US being redirected away from European consumers and towards Asian consumers. Investment funds have once again turned more bullish on natural gas prices as a result of the war, with the number and level of long positions in the market increasing over the last few weeks. Coal. Moving towards coal prices saw a drop over the past week through Thursday. Coal prices, which had seen additional support from the war in Iran as countries such as China and others in Northeast Asia turned from gas to coal in the face of rising gas prices, adding support to coal consumption and demand for coal imports, have stabilized over the past week. The global supply of coal remains adequate, particularly given the increases in domestic production out of China, alleviating some of the concerns regarding decreases of Indonesian production. Over in Europe, while gas to coal switching has been increasing demand for coal, favorable weather conditions and still strong renewable power generation easing demand from the power sector in particular. EU and UK emission allowances. Carbon allowances saw a stable price evolution on the European side of things, with the UK market seeing a noticeable increase of around 12% over the past week. Nonetheless, prices on the European side of things are up roughly 1.6% over the past month. Overall, market expectations of action taken by the European Union and the European Commission to help bring the price of carbon allowances down met some disappointing news over the past week, given that the proposed measures being discussed by the European Commission have fallen short of market expectations. On the UK side of things, again, the main driver of the continued added upward pressure on prices are the ongoing talks of linking the EU and UK carbon markets. Carbon sector emissions saw an uptick versus a couple of weeks ago, largely driven by the gas to coal switching that is taking place in the power sector. Nonetheless, favorable weather conditions and lower total power demand helping ease emissions from the power sector to near the lowest levels over the past 5 years. Investment fund positions on the European market are beginning to stabilize, with a fewer decrease in the level of long positions in the market as markets recalibrate based on the latest reporting regarding what actions the European Union might take to combat high prices. On the UK side of things, fundamentals remain unchanged, with the linking discussions continuing to keep those positions in net long territory. Electricity. Electricity prices over the past week similarly saw a decrease on the back of falling natural gas prices. The decrease was most noticeably felt in the remainder of 2026, down 6% for the third quarter and nearly 7% for the fourth quarter. Nonetheless, pricing remains elevated versus before the war on the back of those higher gas prices, although the drop and carbon allowance pricing, helping ease the bullish pressure on electricity prices. The evolution was very similar across other European markets, particularly those that had seen more upside since the beginning of the war. Looking at total demand and residual load, we see the further decrease in both. On the demand side of things, largely driven by weather conditions, reducing total demand, and residual load continuing to face strong renewable power generation. Looking at the supply mix, French nuclear power generation remains at very nice levels compared to the last few years, in line with levels in 2025, near the top of the range over the past 5 years. Renewable power generation easing off from the highs that we saw about a week and a half ago and slightly below the record highs we saw in 2025, but nonetheless at very strong levels for this time of year, which in turn have helped ease the demand for fossil fuel power generation, which over the past week has been at the bottom of the range over the past 5 years. The stable outlook for renewable power generation, largely driven by the record levels of solar power output, which have compensated for the decrease in both wind and hydropower generation we've seen over the past week. Fossil gas generation seen further decreases over the past week, in line with the statements before regarding gas to coal switching, as the high price level for natural gas is incentivizing additional coal production, which has seen a nice rebound over the last week and a half. Hydro storage levels across Europe remain mostly below the average since 2015. Most concerning is certainly the deficit that we see in the Nordic region, but also in Italy and France. Lastly, guarantees of origin prices have seen a downward movement over the past week. This follows the compliance deadline on the 31st of March as market participants were settling their positions, which led to additional buying and selling activity, driving up the price level. Following the end of the deadline and the reduction in the buying demand, we've seen then prices relax once again. That covers this week's market presentation. Thank you for joining.